Good morning, guys. Matt from Blaze Capital here today. So today I'm going to go over some longer term investment strategies with you guys. This video is going to be too long to do in one part. So today we're just going to go over the difference between mutual funds, ETFs, and different performances, as well as how to read fact sheets, how compounding interest works, all that kind of fun stuff. So the first thing I'm going to go over is kind of the theory behind passive investing and why it makes sense. So on the screen here, this is a picture of the S&P 500. So it's the top 500 companies in the United States. So as you can see, all the way back here, it's always gone up and to the right, apart from some dips here. But in general, the trend is up and to the right. So it's natural to get pullbacks. So with passive investing, this is money that you don't want to have for probably in like the next 10 years or so, because you don't want to need the money and then have a 50% pullback or a 40% pullback happen, because that wouldn't be pretty for your retirement funds. So that's the general theory. Passive investing works because the market always goes up and to the right. Why does this happen? This happens because when you have a long position, you can only lose 100% from it. So it can go from 100 to 0. However, the gains from said stock can go up infinitely. And the other thing with the indexes is, as companies lose value or go bankrupt, etc., they get weeded out. So in general, it's going to be biased to go upwards, as well as all these companies' main goals are to make money for their shareholders. So they're doing their best job in order to return value and money to their shareholders. So therefore, the price is going to go up and to the right. The benefit of doing index investing versus active trading is diversification. So if you have say 5 or 10 stocks, it's very hard to get proper diversification through all the different sectors. So tech, materials, consumer staples, communications, etc. It would be very hard for you to get proper diversification with, say, 5, 10, even 20 stocks would be very hard to get proper diversification from that. So in order to get a nice diversified portfolio, it's easier to buy 1, 2, 3, 4 indexes, which hold thousands of stocks in them, rather than try and get proper diversification through yourself. It also limits your risk because say you held Nortel and then Nortel went bankrupt, right? So if that was your only tech stock, you're losing 100% value. Whereas if you have an index of 5 to 10 tech stocks, one of them goes bankrupt, the other 9 will hold up the portfolio, right? So there's the basic theory behind that. The other theory is it's very difficult to outperform an index. So there's lots of comparisons on active management versus passive management. I believe it's under 10%. I think it's around 7% for managers that are actually able to outperform the index. So probability-wise, if you're a gambling person, that like a 7% chance isn't a very good chance. So you're probably better off just betting on the main horse. So next thing we're going to go over is how compounding interest works. So this is another theory why the indexes go up, because if you reinvest your returns, it keeps growing your account up. So we're going to go into this calculator here. So we'll start with a $10,000 initial investment, and the average rate of return is somewhere in between 7 and 12% over the long term. We'll use 8%. Just for educational purposes today. Compounding interest yearly, and so the different years to grow is going to change. So we'll say you start investing in your 30s, 40s. So we'll use 30 years to grow. That sounds okay to start. So calculate. So if you put $10,000 in at an 8% return, compounds yearly for 30 years, it's going to turn into $100,000 in 30 years time. This is just a flat out investment, no regular additions. So what's reasonable? This is going to change for everybody. So I'll put the link in the bottom or in the comments for you guys to play around with this calculator. So we'll say maybe $200 a week. How's that sound? So we'll throw that in and then we'll recalculate. So crazy enough, just adding that extra $200 at 8% and then compounding all the gains, that yields $1,000,000, 324,387 and 32 cents. So that's a tenfold increase versus if you just put the initial $10,000 in, which is pretty cool, right? Like realistically, that's probably doable for most people. The initial investment might be a bit hard, so then so say you're starting with nothing, and we'll change that to, what do you think, 400 a week? And we'll calculate that. Actually, 400 is probably a bit, we'll use 400. So that's going to be $2 million at the end of your 30 years. And if we shrink that to $3,250,000, again, you can do this for all your, like, what you're personally able to put into the market. And so if you start a lot later in life, your contributions are going to be, you're going to have to increase the amount if you want to have X amount by the time you retire. So yeah, that's how compounding interest work. You can play around with this calculator. I'll throw it in the bottom for you guys. The next thing we're going to look at is the rule of 72, which is basically just it's basically compounding interest. So the rule of 72 states that you take 72 divided by your interest, and then that's going to be your doubling time for your investment. So if you have 72, here's my calculator. So 72 divided by 8% return that we just talked about. So 9 years for your investment to double, and then consecutively it'll double each time after that, which is going to be the compounding effect again, which is pretty cool. So the next thing we're going to go over is fact sheets. So that's how to read different investment types. So a lot of you will have your pensions and that kind of thing, and this will just let you be able to read those a little bit better and understand what's actually happening. So I have a Vanguard one. I'm a big fan of Vanguard. Their fees are really low. We're going to go over fees in this section. I'll probably talk about fees right now that I have my calculator up. So management fees are the fee that you're paying the company in order to manage the fund itself. So Vanguard, for example, has a management fee of 0.1 or 0.16. I use the MER. It's the management expense ratio when calculating any of the costs. So what that means is the dollar amount that you have you're gonna get charged this. You can figure out in the prospectus usually, like if they charge that at the end of the year or if they take it out of your dividends or how the pay structure works. But that's just the gist of it. So other companies, such as this one, Dynamic Funds, I'm going to bully these guys a little bit because their fees are really expensive. So if we click on this, so they have a management fee of 2.43%, which doesn't sound like a lot, but so we're going to use this other number. So if we have 8%, which is that's our average rate of return just for informational purposes today, how much is 2.43 of 8%? It's a lot. It's over 25% without actually calculating it. So that's a lot. You're giving somebody 25% just to manage this fund, and that's going to be 25% of your returns. So if you're like compounding, that makes a huge difference in your overall returns, right? So we're going to use 8%. We're going to subtract the 2.43% from our compounding interest calculator that we just did at the beginning. So we're going to have our 10,000. Going to get rid of that, and then 5.67 interest. So if we calculate that didn't work. Oh, that's why. There. So your return gets cut in half. So our when we first did this calculation with the 8% return, we got just over $100,000. And then when we cut that return by the management fee from the other company, we get $52,000. So you're giving half of your money for retirement to a company to manage, quote unquote, your funds. even though they're probably not going to outperform the market anyways. So that's not a very good deal. So back to our fact sheet. So that's management fee. That's what that means. So this is the percent that you're paying somebody to manage your funds. So when you're looking at your pension ones, a lot of these are going to be in between 1.5% and 3% usually. So you want to try and pick the funds that are going to have the lowest management fee, as well as like generally track the index. Like you're going to have to pay some sort of management fee, and you're going to have to kind of look at that. And that's the reason why we look at management fees, because that's a huge chunk of your returns that you're giving to somebody. Like sure, 2% doesn't sound bad, but it actually ends up being 20 or 30% of your total money, which is actually a very large difference, especially when compounded over 30 years. So we have the objective here. So this is going to say which benchmark the index is going to track usually. There's going to be different kinds of funds, which are either active or passive. Passive ones generally just rebalance yearly or quarterly, whereas active funds are going to do whatever is within their scope of their objective to outperform the market, whether that is using advanced strategies or moving in and out or switching sectors, whatever. They all have their own kind of what their goal is in the fund. So that's just something to look at. As you'll hear a million times, past performance doesn't indicate future results. So it's hard to actually look at something and decide what's going to happen, which is another reason why most of the time it's probably easier just to do index investing. So key fund facts: the inception date, net assets, total assets under management, 12-month trailing yield, that's the dividend percentage, so how much they pay back in whatever schedule. So some are quarterly, some are monthly, some are annually. And so this is the current one, is close of March. And then your eligibility. So this is a Canadian fund. I know a lot of you guys are in the US. They're going to, it'll have your IRA, your Roth IRA, all that stuff will be listed here on a US one. The total returns here, 1, 3, 5 years, and then inception. So this is what you're going to want to look to in your funds in order to compare how they're doing versus the market. So you're going to look up whatever you can get closest to compare. So if it's a US fund in your mutual funds, then you can look up an ETF or something along those lines, and then just see what the comparison is. So we're going to look at how to compare apples to apples as we get down this sheet here. This is the growth of 100,000. I have a bunch of these done on my comparison sheet. So this is just if you put $10,000 in and didn't touch it, then it would be worth just under 20,000 in how many, 5 years? So that's just some information about that, which is going to be directly correlated to the performance of the fund. This here is the characteristics. So this is really important. This is the number of holdings. So this is how many stocks it's holding. The median market cap, if you line up all the stocks, the middle one's going to be worth 96 billion. The price to earnings ratio is the ratio of the price to earnings per share. Price to book is the ratio of the weighted, well, you guys can read that, the ratio of the weighted average price to book ratio that the stock holds. Return on equity, so that's the percent return over a certain time frame. And then that's comparing to the benchmark. Earnings growth rate, so that's if the companies are actually earning more money over each year. And then this is a portfolio turnover, so that's if a stock has to get removed for the index, or if it goes bankrupt, or whatever happens here. The top 10 holdings is obviously the top 10 holdings. So this is something to look for if one of your funds says it's matching the US and these don't match up with the index that's underlying. That's probably a problem, or it could be a problem depending on how the performance is. This is the sector weighting. So this is which percentage of each sector is involved in the whatever product you're looking at. So this is really important to look for as well, because if you're too overexposed to certain sectors, and if there's a big technology crash or financial crash, and industrial, etc., if you're very overweight, so the Canadian index, I think, it's about 60% financials last time I looked. So if you have a lot of money in that and there's a big problem with financials, your fund's going to lose a lot of value. So we want to get really good diversification here and make sure we're not too overweight in one sector or one company. So there's cap weighted and non-cap weighted funds, which for those reasons, so it'll keep a certain stock. So if one stock's 5 or 10% of the portfolio, if that stock gets into trouble, it's going to have a big effect on the product itself. Whereas if it's spread out, so I'll just do a couple examples. Kevin O'Leary's funds, he sector weights everything to try and keep it less than 5%. So this just provides a little bit more, more rule-based approach. It's not necessarily going to be better or worse. It's just all about risk management. So if you keep the sectors a little bit spread out, you might be missing some upside, but you also might be missing some downside. So that's just a personal choice that you have to make. Whereas if we look at the S&P, it's 25% technology. So if we ever had a big problem in the tech sector, that's going to really hurt that index, right? So this is just another thing to keep in mind when you're looking at your funds. And then there's the market allocation. So this is going to change dependent on, so this is it's a US fund I'm looking at. Whereas if you look up one of the other funds, it'll have like Canadian percentage, Europe percentage, etc. So that's something to look at when you're comparing different sectors as well, different products. So if you're looking at a global fund and it's, we'll say 75% US or something, and you already have a fully US fund, you're probably getting a bit of overlap there. So you may think you're really diversifying yourself, but in reality, you're still going to be very overweight to the US, which some may or may not say is a bad thing. So Warren Buffett, I believe, and Jack Bogle, however you want to say it, they both believe in like being super heavyweight into the US, just because their philosophy is that the US has a very large reach, and a lot of the companies in the US are going to have a large reach globally anyway, so you're still going to be partially diversified that way. I'm not a financial planner or anything, so I'm not going to overly comment too much on portfolio allocation. We'll go over some kind of rule of thumbs in the next video, but today I just wanted to go over all the different how fees affect all your performance. So the next thing we're going to go over is a spreadsheet I did. I tried to compare apples to apples as best as I could, but it's very hard to get everything matching. So I tried to match them as close as I could based on their weighting and their holdings, etc. But there's just so many different funds, and I probably spent 6 hours looking through all of them. So I have a list of Canadian ETFs and a list of US ETFs. These in general would be some that you would be holding to get a nice diversification in your portfolio. This is not an example of what you should be holding exactly. It's just going to be for comparison purposes and how they affect your performance. So first one we have here, this is a Canadian ETF. So this is the Vanguard all cap US fund, I believe. So these are the returns, the 1, 3, and 5 year, and then the management fee. And then we have the rule of 72 we went over, so that's the doubling time, and then the growth of 10K over 5 years. So this just compares the performance of some mutual funds versus ETFs. This is not all mutual funds are going to underperform, but most will. This is just something for explanation purposes. So we look over Vanguard here. So you're getting 10% more here, 6% more here, and then roughly 5% there, and you're paying a lot less of a management fee there, right? So you're paying almost like 2.45 less management fee percentage. And as we went over before, that's a huge difference on 8% returns, right? So doubling time, the difference was 2.7. So it took 2.7 years or 2.65 years longer to double. And then your growth over 5. I used 5 years just because the data was easier to find. It was kind of hard to find data on 10-year for a lot of the funds because they just haven't been around that long. So over 5 years, you're going to have an extra $4,000 in your pocket here. Next one we're going to over is Canadian equity, which is the Canadian index. So we have drastically overperformance here, much less management fee. Doubling time, so your doubling time here is 14.5 years, and then so it's going to take 8 more years for your investment to double in this fund. Again, all these doubling time, or the growth rates are all based on the 5-year, and then the doubling time is taking the 5-year compounding interest and then dividing 72 by that number. That's how I got those numbers. I'll share this spreadsheet as well if you guys have any interest in looking at it. This one is except Canada. So this, like I was saying, is going to be, you're going to have a bit of overlap from the US if you were to buy this one and one of the US equities. So that's just something to keep in mind. So if we look here, this 1 year, this fund actually did outperform. So again, like I said, like not always, depending on which stocks and which weightings the different products have, they're going to underperform or outperform at different time periods, but the management fee, that doesn't change. So that you're just by default, you're saving yourself 2%, 2.2% actually, just by going with an ETF. So I didn't have data for the 5 years, so I just pulled the 3-year data for this one. And these ones are actually pretty close in performance. So whoever's managing this fund is doing a pretty good job. And the growth growth over 5 years is just about a $2,200 difference, which is not as bad as some of the other discrepancies. So next one is bonds. I'm gonna go over like bond weighting and that kind of stuff in the next video. Bonds are just fixed income, whether they're from Canada, outside Canada, global, US, etc. These ones are Canadian funds just for comparison purposes. So these are the return rates again, and then the management fees here. So Vanguard is always really low, like under usually 0.25, whereas again with all these mutual fund companies, you're going to be paying over 1.5 for the most part. So doubling time, 19 years for this one, 55 years for that one, and then the growth here. So bonds are most of the time going to underperform stocks, but the benefit of having them in your portfolio is you're able to rebalance. So when stocks are underperforming and bonds are overperforming, you can pull money from your bonds and then put them into the stocks that are underperforming, and it's just a way to kind of keep some spare money around for when the market does go down. So this one is for some US comparisons here. There's a lot better selection in the US than Canada. There's just so many more companies, and there's also really the competitive advantages to having lower fees in the US, so you're going to get a little bit lower fees in your US ETFs than you are in Canada. So again, I use Vanguard for most of the low management fee ones. So this is pretty drastic actually, this one. So we have 14% and then 0.83, sorry. So you're getting 14% more return for this one. There was no data available for the 3 years and then for the 5 year. So management fee, this one wasn't overly high, but you have a risk of underperformance as well when you're not matching the index, and this is clearly showing that. So the doubling time for this fund is 4 years, whereas this one's 122 years, and that is way longer than any of us are going to be alive. So really something important to look at. And then your growth. So this one doubled in our 5-year holding period, whereas this one made you like less interest than the bank, which is just terrible. So the next one we're going to go over is global. So this one is Vanguard except US. There's performance again. So performed a little bit better, 2.7 better, about 4.5%, or sorry, 3.5%, and then 2.4% roughly. And then the management fee really high here and very low here. Your doubling time 26 years, and then this one 225 years. So that's even worse than this one, twice as bad, almost twice as bad. And then your growth of 10K over 5 years. The Vanguard one wins again. And then last thing, so we got US bonds to look at. So we have 3.6%, 1.83. I don't think this one had the 3 either. And then the 5 year. So management fee, way lower, 0.9. Doubling time, 48 years. Doubling time, 110 years. And then your growth of 10,000 right there. So yeah. I'll probably save the other topics for the portfolio construction actually. So that's the gist of what you should be looking for. So sorry, I didn't even explain what the difference between ETFs and mutual funds are. So the ETF stands for exchange traded funds. These are the ones that you can purchase through a brokerage. There's different brokers such as Questrade, Scotia Bank I think has some ETF purchases for free, and some of the other banks as well. I don't have a full list of all of them. So those, and then some of the robo-advisors such as Wealthsimple will also purchase ETFs for you on your behalf, charge you a small fee, and then they will put you in different allocations of different funds based on what your risk tolerance and your time frame and all that stuff is. So yeah, that's just the basics there of how to look over different things in your investments and just how to do comparisons on them so you can make a little bit more informed decisions. And then next week we'll try and go over a little bit more portfolio construction and that kind of thing. Okay, awesome. Thanks guys. Let's make some money.